gang, I'm going to introduce my dear friend and, dare I say, genius, Toby Mathis. I'm so pleased you guys are here. Oh, and there you are. There's your handsome mug. I love it. All right, gang. So again, Simpler Trading is very proud to introduce you guys to Anderson. And Toby is going to walk you through a presentation not unlike what I first sat through many, many years ago, and one that I know is going to make a huge difference in your trading. So again, I'm Raghee Horner. For those of you that may not know me, I've been trading futures, Forex, and stocks for, well, let's just say a really long time. And what I'm here to talk about is not me. I'm here to talk about Anderson Advisors. And really briefly, this isn't just about you as a trader, but this is really you in many facets of your life. This is not just how do I take advantage of my education, my costs as a trader, how can I structure my trading to be more tax effective? Yes, we want to protect our assets, decrease our tax burden, prepare for retirement. Absolutely, Anderson can help. At the end of the day, gang, proofs, the proof is in the pudding. I've known Toby, and actually back in 2005, to give you an idea of how long I've known of, been educated by in the world of intelligent tax prep and tax smart corporate entities. Toby's going to go through all this. But back in 2005, I think I actually met Clint or watched a seminar that Clint did out in California, and it blew me away because nobody was talking about entity creation. They were stuck in the old school ways of how a trader could have a more tax effective approach to their trading profits. And what blew me away about Anderson and what convinced me back in 2005, so 14, 15 years ago, was just the very out of the box and yet absolutely common sense approach. All right. So again, for me, I'll tell you, it's strategic, it's sanity, it's your secret weapon. And Anderson has helped me create the entities through which I trade. I personally use them. I have a number of entities. Toby's going to walk you through some of the advantages. So at the end of the day, I'm a big fan. I always sit and take notes when Toby speaks. He is extremely knowledgeable on the topic. And, I'll tell you what, Toby, is the best thing I can, I trust you guys with what I do, but you know what? My sister even works with Anderson. My sister, whom I love more than anything in the world, her very first entity is with Anderson. So it's a family affair with us. So I'm going to, without further ado, just get out of Toby's way and sit tight.
You're always such a sweetheart.
Take notes. It's
You're
true.
So nice.
It's true.
Well, Raghee, you've always been awesome. And Raghee does a lot. Like you guys don't know me from Adam necessarily, but we bring Raghee in to talk to clients quite often too, because she's so methodical. And just give you an idea who I am and what our firm is. I'm a tax attorney by trade. Let me see if I could actually figure out how to share a screen here. Which one? There it goes. So you guys should be able to see it. But I'm a tax attorney by trade. Our firm really cut its teeth on working with investors. To give you an idea of scope, there's about 300 of us, and we work almost exclusively with traders and investors in real estate. We have the business owners in there, but I don't work with people that are just W-2. I work with people that actually are trying to grow their wealth. And we do over 6,000 tax returns every year for those folks. And I see who makes money and who doesn't. And after 23 years of doing this, I can tell you pretty definitively that the characteristics break down into small categories. And I'm going to show you what about 80% of the people do, what about 15% of the people do, and what about 5% of the people do. And it's not going to be surprising that the top 5% do something very differently than everybody else, and that even the 15% do something different than everybody else. And you'll realize it's a little bit about leveling out the playing field. So I'm going to give you guys a little bit of a roadmap of what we're going to cover over the next hour. By all means, type in questions. I actually read them while I'm going along. So if you see my eyes darting, I don't have as many screens as Raghee. I think she's up to like 6. But I have 3 in front of me, and I read what you guys are writing. I'm used to it. I teach all the time. Do a little something called Tax Tuesday every other Tuesday that's completely free. You can ask any tax question. There's no cost to it. You'll find me on the internet. Type in tobymathis.com and you'll find it. It'll take you to our site. But we're all about educating people so that they can be better investors. And that makes you a really good client. Because frankly, we don't want people that are losing their katush. You don't stay a client very long because there's nothing for you to do. Like, we really focus on people that are growing their wealth, and you're in a good group with Simpler because that's the focus. Everybody's aligned. And what you realize a lot in this world is that not everybody is aligned. Sometimes their best interests are not your best interests, if you know what I mean. A lot of stockbrokers are like that. And you guys may not even remember, but I still remember when I got into this business and working with investors, you couldn't trade online. You had to use a broker. It was $70 single way, about $150 a round trip on trades, and you had to have a pager so you knew when things were moving. And we've come such a long way over the years. It's pretty amazing when you think about it. But I remember those days, and it wasn't like, sometimes it was just churn and burn is what those guys were doing. Now you can't do that anymore. We're seeing a lot more alignment. So anyway, so you guys are in the right place. Here's what we're going to go over today. We're going to go over different options that you have for holding your trading account. We are going to go over how successful traders take advantage of the tax laws. What you don't realize is that you've been put at a disadvantage, and I think it's deliberate by Congress to put you at a disadvantage, to shake you out. They don't treat you like other businesses. They don't allow you the same tax breaks as other businesses. In fact, they put you at a disadvantage to somebody else who's trading somebody else's account. They get far more tax benefit unless you do a couple things. And I'll show you how to do those couple things and how you take advantage of it. Because after all, what good is making a 20% return if you're giving half of it away? What I really care about is people making a return and getting to keep it. And if they do have a year where there's losses, that we're able to take advantage of those losses, if that does happen. Because it's not fair that in one year I can make $100,000. The next year I could lose $100,000, but I can't offset the year that I made the 100 with the year that I lost 100. I'm going to be carrying that $100,000 carrying forward. Like, basically I can write off $3,000 a year. So I'm going to be carrying it forward for about 33 years. Doesn't make any sense to me. It's not fair rules. So we're going to even it out so that it's a level playing field with everybody else. And then we're going to go over why the heck do 90% of the traders leave so much money on the table, and how you can make sure that you're not one of them. Because you are a business. When you're going in and you're spending the energy and the money to learn, like, for example, it's really easy for me because you're all with Simpler. I know that you're paying money to be with Simpler. I know that you value the education. I know that you value the group. Why won't they let you write that off? And believe it or not, you can't write that off when you're an investor. In the vast majority of people are going to be treated as an investor by the IRS. I mean, we're talking about upwards of 90%. So you're going to have to opt yourself out of that. There's only a couple ways to do it. One of them is extremely dangerous and will get you audited, and the other one gets you nothing. For more than 20 years, we've been doing this successfully, where everybody gets really great benefits without the harassment, whereas a lot of accountants will tell you the other route that's going to get you harassed. It's called trader status. We just don't want it. A little bit about us, a little bit about me. First off, to whom are you listening? I'm an avid investor. I do stock trading, but I'm also an avid real estate investor. I'm not going to lie. I have over 200 properties nationwide. I love investing, period. Where I tell everybody to start is in the stock market. There's two asset classes that have made the most over history. And if we just go back to like 1940s, it's not even close. And that is rental real estate and stock market. And they're always going like side by side. But everything else is in the dust. Gold is in the dust. Your house is in the dust. Everything else is down on flat. But if you want exponential growth, you're going to have to be in the stock market. That's what we teach. And I can just tell you, because I look at who's successful and I say, here's what they're doing. Don't shoot the messenger. This is what they're doing, right? This is what they do every year. It's really kind of boring. They do the same thing over and over again, get the same results over and over and over again. Don't have a lot of drama, like what they're doing. It's kind of weird, but it works. And so I really I'm a student of it is the easiest way to put it. Anderson Advisors, business advisors. We've been doing this for over 20 years. about 300 of us, CPAs, attorneys, EAs, accountants, advisors, bookkeepers, you name it. We try to be a one-stop shop for somebody who's an investor, so you don't have to go bouncing around. Here's my accountant. My accountant says something. My attorney says something different. My financial advisor says something different, and you're playing ping pong between them. We try to eliminate all that so that you're under one roof. So we focus on tax planning, estate planning, asset protection. It really comes down to 3 words, which is preserve, protect, and prosper. It's your money. We treat it like it's your money. We protect it like it is something sacred, and we make sure that you're keeping it, because after all, you're better at using it than anybody else. And I'm a believer that people will do the right thing if they have funds, and they'll help other people, and that we're way more efficient than the government. So I'd rather you keep it than give it to government bodies. Not against taxes. I just don't think we need to leave them a tip. A little something else that's not, it's not always on the beaten path, and that is that Andersen isn't just about the clients. We've been a Business of the Year. We've been on the Inc. list 4 different times during our existence. We're a very good company, but we also treat our employees well. And we're also very good on our technology side. So we've been a national best places to work. And this year, these are the awards we've gotten this year. Every year it's, you know, there's something popping out there that we qualify for, and somebody nominates for something, but we've been a great places to work nationwide, locally in Las Vegas. We have offices, by the way, in Washington, Cheyenne, Wyoming, Salt Lake City, Arizona. In Las Vegas, we have 3 offices. We have registered agent offices in all 50 states. We can work with you in any state. We can even work with international clients. But where our home office is here in Las Vegas, we were Review Journal Best Places to Work. We actually got number 9 in the state. So, you know, that's with all the casinos and everybody else with all their billions of dollars. And here's little old us with our, you know, hundreds of employees, not thousands. And we're competing with the big boys just because we really do whatever we can to take advantage of the laws to enable us to benefit our employees. Same thing you'd be doing. Intuit gave us a From the Future. Somebody asked about software, and we love working with QuickBooks. I don't even think you guys would have to, because you can do summaries out of your brokerage accounts. So if we can avoid you having to pay any money, we do. Quite often it's cheaper than the software to have somebody else summarize your data on a quarterly basis. So we're very, very good at that. Somebody says, can you work in New York? Yeah, absolutely. I grew up in Philadelphia, moved out to Seattle, lived there for 25 years before moving down to Vegas. So very familiar. We work all over the country. All right. Here's what I have a problem with. The IRS and the Internal Revenue Code, all 20-some thousand pages of it, over 1 million pages of summary, right? It's not exactly easy to read, and it's not exactly a fair document. So one of the problems that I have is that I could go out and I could choose to be a plumber, and I could get my tools, I get my plunger, I get, you know, put my ad out there and start doing work. And I'm considered a business. I am considered a business, which means I can take business deductions. It's called 162, section 162, business, ordinary necessary business expenses. When you're an investor, you have 212, which is called investment expenses. What you don't get to take are your ordinary necessary business expenses, like those computers, like the education. All that stuff goes to the wayside unless you are trading for somebody else, like you have licenses and you're managing somebody else's account. There's 2 exceptions to that where we can create something, and I tend to use an entity called a corporation to create a business, so I don't have to worry about messing around and qualifying for things. Or you could become a trader in securities and make an election, which you'd have to qualify for. And I'm just going to tell you guys, 99.9% of the time, I say don't do it, because you're going to get audited. I'll explain why a little bit later when we go over how you report it, and you'll understand why. It's because of the way it goes on your personal return. There's no such thing as trader status in the Internal Revenue Code. It's something that somebody made up and started listing on its tax return. And the IRS says, well, if you're going to do it, here's how you do it. Then they just audit everybody that does it. And most people lose, like the vast majority. There's very few cases where you see that they'll actually win. But anyway, let's just say that this guy, and I don't mean to be sexist, but I just put a dude as the plumber, but it could be a lady just as easy. Let's just say that this guy makes $100,000 a year. They're taxed as ordinary income, so it's at their bracket. So I'm just gonna or at their tax bracket. So it's ordinary income. Because they're sweat of their brow, because they're doing the work. Like here's the big wrench, so we can see they're having to do stuff, right? It's also subject to something called old age, death, and survivor, or disability and survivors benefits, and Medicare, also known as Social Security. Social Security, also known as self-employment tax. So you have a little social. Let's see if I can spell tonight. Social Security, self-employment tax, and this is 15.3%. It's what gets withheld out of everybody's wages. There is a portion of it that phases out. I'm not going to get into all the specifics. It's when you get over 137,000 of active income, then only a portion of it's still charged. But you get the self-employment tax. That's kind of the downside. But you also get to take off all your expenses, including that wrench and the traveling and the driving and maybe their coveralls and their plungers, their cost of equipment, their advertising, everything else. They get to write off. And it's called Section 162. And it's what all businesses use when they're writing things off. It's actually really effective. The other thing they can do is, because this is ordinary income and it's active, they can use that money to fund IRAs, 401ks, DB plans, defined benefit plans, cash value plans. The other thing they can do is, if they have a loss, they can carry back losses. This year it's 5 years, and then they can carry it forward and offset years in the future. Like, so for example, let's say that this is Bob the plumber, and Bob has a really bad year this year because there's a pandemic and he's not getting to do a lot of work, and he loses $50,000. Bob is allowed to carry that back all the way to 2015 and start using it against taxes he's already paid. And he could eliminate, let's say he made $50,000 in 2015, then any taxes he paid in 2015, he can get back. Now let's call this Jimmy the Trader. Sorry to make them both dudes. I didn't even think about that until I'm looking at it. I have a daughter and she'd probably yell at me. All right, so let's just say it's Jimmy the Trader. Jimmy loses $50,000. Jimmy can't do anything with it. Jimmy can't carry it back. Jimmy can't do anything. Jimmy's just a trader. He's just sitting there trading. And the IRS is going to call Jimmy an investor. 99. If Jimmy has another job, or if Jimmy doesn't trade every day, the rule of thumb, just so you know, is that you need to do about 1,000 trades per year. And you got to trade on about 150 days. In other words, all year, consistently throughout the year, about 75% of the trading days you need to be trading on. Otherwise, you're not even going to be considered. So this is the minimum that I would say. That's the minimum. Just to even start going down the road. Otherwise, this is what happens. When you're a trader, he makes $100,000. He's going to be treated to something called capital gains, which, if it's short term, less than a year, and I'll go over this again, so don't worry about having to write everything down. If it's short term, it's your ordinary rate. It's at your normal tax rate. If it's long term, over a year, you held it over a year, it's 0, 15, or 20%. And yes, Biden wants to make that into 28 and 39.6, potentially. We'll see. I don't think he'll get it through. But no expenses. Any expenses that he incurred, you can't have. So let's say, same scenario, let's say Bob had $100,000 that he made of income, but he had expenses. He had unexpected expenses at $150,000, which caused him that loss. If you had $150,000 of expenses, which would be really hard to do as a trader, though I have seen people come close, you can't use it. You lose it. Literally, you'd still be paying tax on $100,000. So we don't like that. That's just not very nice. Certain expenses can offset the $100,000, but it has to be considered an investment expense. And it would only be things like your interest and stuff like that on a margin account. You're limited to a $3,000 a year loss. That's your limit on capital losses, which kind of stink all us. You cannot fund retirement plans with any money you make. It's considered capital. You can't fund it. You have to have active income, and can't pay for any education, any of those things. You can't deduct. And people say, yes, you can. You can do it as miscellaneous itemized deductions. There have been no miscellaneous itemized deductions since 2017. There are no such thing. It's not on your Schedule A anymore. They did away with it under the Tax Cut and Jobs Act. It's gone. So there are no miscellaneous itemized deductions. Something says, what is considered a trade by the IRS to make up this $1,000 a year? If you buy 4 contracts, is this considered one trade or 4? One. And it's a round trip. So it's the entry and the exit. So here's what they say. This is the IRS's rules on trader. And this is why it's so frustrating. There's people that have made $15 million a year and been called an investor. There's been people that traded well in excess of the $1,000 of trades a year, but they weren't frequent enough because they only traded half the year. One gentleman traded about a quarter, made a ton of money, and then took the rest of the year off. And guess what they said? You're an investor, because somebody who works every day. And so they look and they say it has to be regular, frequent, and regular, that is substantial. So they're not going to like it if you're just getting in and out a little bit. And this is the big one, daily market movements. Really what they're talking about is somebody that's in and out of positions all day long, that sits there and exits. And they use a facts and circumstance test. So whenever you hear facts and circumstance, it means they're going to go to court and you're going to tell it to a judge, and the judge is going to decide. The problem that you have is that's usually 5 or 6 years after you were engaged in the activity. And so I can just tell you, as an attorney, I would never tell you to do it. Just don't. There's another way to do it, and I avoid it. But if you do become a trader, like if you're doing 3,000 trades and that's all you do for your, like Rogge, for example, she would qualify as a trader. That's all she does, right? If this is all you do, maybe you qualify as a trader. There's other reasons that I still wouldn't do it, but you would qualify, right? Some people they just want to be told that you qualify as a trader. Congratulations. But here's some other reasons why you may not want to do it. Besides getting audited every year, I just don't want to deal with it. Your losses become ordinary when you're a trader. Your losses then can offset your other income. And you'd be surprised at how many people lose $500,000 in the market being a day trader. I would guesstimate that most of the folks that are out there don't know what they're doing. They don't trade as a group. They don't have good instructors, and they go blow their money away because guys like you are going to take it from them. Professionals are going to take it from them. They're going to go out there and they're absolutely going to make mistake after mistake after mistake, and nobody's watching them. And they went and they bought a program on late night TV, and all of a sudden they think that they're the best trader ever. And the next thing you know, they're $500,000 in the hole, and they can't write it off. If they do qualify as a trader, in order to write it off, they still have to do something called a mark to market. And there's a ton of cases out there where somebody qualified as a trader. The accountant even said, hey, you're a trader, but they didn't make the mark to market election. And you have to do it by April 15th of the year in which you want that election to work. And all mark to market election means is I treat your shares as though you're selling them on December 31st, whether you do or not. Now, I'm old enough to remember Qualcomm shooting up. I remember those days when Qualcomm went up $600 at the end of the year, and people that had leaps, I had leaps on it. Anybody that was trading that made a ton of money. If I had a mark-to-market election, I would have been paying a ton of tax on December 31st as though I'd sold it, because that was when it was peaking. And then it went and did a face plant. The next 3 months, it absolutely just tanked and torpedoed. Everybody thought it was the darling, and then the next year it just gave it away, and then the tech bubble burst and all this horrible stuff went on. You would have been hard-pressed if you had sold your shares to make up enough to cover the tax burden on what would have happened just because you had a mark-to-market election. I've been scared of them ever since. Now, that was about 20 years ago, and I still see people going out and telling people to do the mark-to-market election. I'm like, it's fake. I don't know why you're doing it, but you have to be a trader to do it, and then you have to make that election prior to the year. Otherwise, your losses are still considered capital losses. And capital losses are limited to $3,000 a year. They can be used against other capital gains, but but they're not much use against anything else. So if you have any sort of capital gains, it doesn't matter whether it's short term or long term, and you have capital loss, those capital losses will offset. So the best scenario, just to tell you, like I'm not doing this out of the presentation, but quite often somebody will have long-term losses on a company and they'll be holding it. And then they'll have short-term gain. They'll sell some options or they'll have some short-term gains on a company. And I'm like, sell your dang loss. You're going to offset that gain. That gain is at your ordinary bracket. A lot of these guys are in the top bracket. So they're sitting there at 37% plus their state. Some of them are close to 50%. And I'm like, you're going to eliminate that tax just by selling these unrealized losses. Just do it. And they're like, well, this is long-term loss. I'm like, I don't care. It offsets all gain. So like, just keep that in your head. All right, let's go over one other thing. When you're a trader, you write your expenses off. If you know how a 1040 works, you're going to have Schedule B where you have your dividends and interest. You're going to have Schedule D where your capital gains are. You're going to have Schedule C where you're sole proprietor, where your active business is. What happens when you're a trader is you're reporting your income on B and D, and then you're just having a big fat loss on Schedule C. There's a section of the code called Section 187. It's also known as the hobby loss rule. It says you have to make money 3 out of 5 years, or they're going to consider your activity a hobby and disallow your deductions to the extent they exceed the income you made. Well, there's no income on here. You're just basically waving a flag at the IRS saying, please audit the crap out of me because I'm going to write off losses, even if you're making money. Like you could be making a ton of money over here on Schedule D, but it's still treated as capital gains if you're a trader and they're writing off the losses on Schedule C. Like if you understand how taxes work, you're like, this is a very, very bad idea. When I look at the IRS data book, which I do every year, it just came out again. They always talk about who they're auditing and who they're not. A Schedule C filer who's making 100 grand is literally like at a 500% greater risk of being audited than their cohort who might be a corporation or just a regular old individual. You throw that Schedule C on there that's losing money every year, and you're going to jack that up even higher. And this is the sad part. Schedule C filers lose their audits about 94 to 95% of the time. They lose. Their success rate, according to the IRS on their own data book, is between 4 and 6%. It's in the toilet, guys. I would not wish that on my worst enemy, yet people still do it. And if you are doing it, stop it. The audit's not worth it, guys. I'd rather never be audited. And I'd still like to write everything off. So let me go over how most people act. And if this is you, I apologize. This maybe is your wake-up call. But a lot of times we trade, and that income goes right into our personal account. In other words, you own the trading account. It's in your personal name. So if you make $20,000, you made $20,000. It's going to be reported to you on your 1040, no matter what. There's nothing you can do about it. And even if you have expenses, you don't get to offset that $20,000 with any of the expenses. So you just have $20,000. And this is going to be, in most cases, when you're trading actively, it's short-term capital gains. And this is going to be taxed at your highest tax bracket. Now, maybe you're doing Forex, maybe you're doing futures. If you're there, then you have this little 60-40 thing where you're getting 60% long-term gain, 40% short-term gain, no matter how long you hold it. I get that, but I'm just going to say this is what I see. There's nothing they can do. What about retirement? Nothing. What about business planning? What about growing another business? What about helping my family out? What about during COVID being able to write off catastrophic expenses? What about being able to cover living expenses tax-free? Can I do any of that? No. Can I have a family council and have them learn how to do this stuff? How am I going to transition to my kids? You can't. It's you. And this is just about any business. It's not just traders, but just about every business. This is how they behave. And it ends up costing them quite a bit of money in the long run. Then there's number two. And number two is they have the trade account and they'll have it inside of a business and it just pays it out to you. And that's not so bad. They'll just say, hey, if I made the 20,000, if I have it in a business, then I'll expense it. So I have my expenses, and then I'll put the net and I'll pay the net out to myself. And they're either doing this as W-2 if it's a C Corp. They're doing it sometimes as a dividend. If it's an S Corp, it might be a distribution and it still might be capital gains. But they're paying themselves out in some other way. It's not just automatically flowing to them as capital gains. You can change it. Now, the good news about this is you can actually fund a 401k in this type of structure, because now we're able to start paying ourselves out, especially if it's a C Corp, we're paying ourselves out W-2. We can literally defer, anybody can defer $19,500 into a 401k. If you have the gray hair, you're over 50, you get an extra $6,000. Plus, the company can match another 25% of that. So we can go all the way up to $57,000 per 401k. So they're kind of a nice situation. You actually have a pretty ideal, but it's not the greatest. And I'm going to show you the greatest. The greatest is do no harm, but only do benefit. And what that is I put a trading account, and this is almost always in an LLC. There's some situations where you use an LP, a limited partnership, but it's almost always, for my purposes, I'm just going to say it's an LLC, and there's a partnership arrangement. And that partner is a corporation, or an LLC taxed as a corporation. So LLCs do not exist to the IRS. They ask you to tell them how it's going to be taxed. So it's usually a corporation, and it's usually like, let's say, a 20% owner. It could be 1 to 20 or so, but there's a reason we do this, and here's why. Number one, that trading, whether I remove it from my LLC or not, is going to retain its character as capital gains. It never switches. Whether I just leave it in there and it all flows down to me, whether I take it out of my trading account or not. If I just leave it in the LLC, I still pay tax on whatever the gains are, but they retain their character. 20% is going to go up to this corporation. So let's say that I made $20,000. $4,000 is going to go up here. $16,000 is going to go down here. If that was all short term, that would be taxed at my highest bracket. This $4,000 though is going to be expensed out for your simpler trading, for any of the data that you pay, if you travel to go to courses, if you're reviewing companies, if you're traveling around, if you're doing an administrative office for your home, if you're doing home meetings. And I'll just tell you that on average, an average client, I'm going to find you between $20,000 and $25,000 per year of expenses that you're already paying that are actually something that you can be reimbursed for. And before you think that I'm nuts, I'm just going to give you one of them. Let's just say it's a cell phone. Can't write it off if I'm an investor. If I'm a sole proprietor, I can write off just the portion that's used for business. But if I am an employee of a company, and that company would work if it's a corporation. So I'm just going to write corporation up here. If I am an employee of that corporation, I don't have to take a salary, but it can reimburse all of my business expenses. And it doesn't have to separate it out when it's a cell phone or if it's something that's for the company's benefit. I get to write off 100%. So I would be paying myself, let's just say that it was $4,000 that I had automatically made. All right. And my cell phone bill, I don't know what you pay for your cell phone, but let's just say it's $1,500 a year. Perfect. I can do that. And it comes off the $4,000. I get to write myself a check for $1,500. Do you know where that gets reported on your tax return? It's a trick question. It doesn't. It doesn't show up. It's just like your employer reimbursing you for expenses. It shows up on the company. and companies have all sorts of data expenses. It's just not unusual. And the law says it has to be 100%, and it's not even you're entitled to it. So this is a 20%, and yes, with the partner, with you being 80%. So you're out here as 80% partner in that LLC. So the corporation is 20%, and you are 80%. You could mess around with that. But here's the cool part. Let's say that you did have $20,000 of expenses. What we do is this $16,000 can be paid up to the corporation. And again, we put a contract in place in the very beginning, and it's called a guaranteed payment to partner. And that's really, really important, because a guaranteed payment to partner is active income to the corp, and it comes off the top. So all of a sudden your tax bill just went to zero. And the corporation now, and I'll make it a little bit bigger. So the corporation and you, so let's say this is an LLC, you're 80%, corporation is 20%. The company made $20,000 in gain. It paid $4,000 up here immediately. So that made that 16. And then it paid the rest of the 16 up to the corporation. And it's called a guaranteed, I think it's only one R, guaranteed payment. And what that did is it just made your portion of it zero. So your tax is zero. And now we have $20,000 sitting in the corp. The corporation's tax bracket, by the way, is 21% if you didn't expense anything. But we already talked about some of the things we're going to expense. Let's just assume we're able to get the entire $20,000 out. You're just going to have to take my word that when we go through this, it's not difficult. A 288 deduction, the ability to rent your house, is about $10,500 a year. Your administrative office in your home, which is not a home office, those are roughly around between $3,000 and $4,000. Cell phone, medical, dental, and vision, you can reimburse anything that comes out of your pocket if you have a C Corp. All of that is going to factor into this. Plus, if we wanted to, we could defer the entire $20,000 just by paying you a salary and deferring $19,500 of it. Boom, gone. All of a sudden, our taxes are what? 0%. So everybody's a little different. I just used, if you were in the 37% tax bracket, if you're trader one, you're getting to keep, because remember, you had $20,000 of expenses you couldn't deduct. So you spent that, plus you paid taxes at 37%, so $37,000. You're going to get to keep somewhere around $43,000. Maybe it's 43. It's probably 43. I probably have an extra 200. It's 43,000. Trader number two, in that particular case, we had it run through the business, and all we did is run it through the business. If we did that, we're going to save ourselves. We're going to be plus 23%. We're going to save ourselves about 10 grand because we got to write off that $20,000. All of a sudden, we have a business. If I just paid it back out to myself, I'm going to save myself, quite a bit of money. But I get to write things off. Congratulations, you get to write things off. And then trader number three, they're getting, not only they're going to get the $20,000, they're going to keep it in a better tax brackets, but they're going to get those deductions off, and they're only paying tax now on $80,000. See, up here, you're paying tax on $100,000, even though you had $20,000 of expenses. So you paid $37,000 in tax, period. Plus you had to pay your $20,000 in expenses. So you ended up coming out of pocket between the IRS and your expenses of $57,000. So my number is a little bit off. That's actually a zero. $57,000. Down here, if all we did was eliminate that $20,000, immediately our take-home revenue jumps up. And that's the biggest difference. If you ever want to ask somebody, what's the difference between that top, I would say 5%, is that they've realized there's so much more that you can do. I sit here and I have my corporation. And by the way, this is the typical structure that you see. And this isn't rocket science or anything like that. If you did nothing else, that $20,000 would just go onto your 1040. And actually, if you did nothing else, it wouldn't be that, it would be 16,000, because 4,000 would come up here. And that would be taxed at 21% if you didn't write anything off, like you just lost your mind and you said, I'm not going to do anything. The 16,000 would flow down to you under your Schedule D. If it's interest or dividends, it would go on to your B. If you have futures, it's going to be that same 60-40. In other words, it doesn't hurt you at all. So we used to have an easy saying whenever we would start working with people, especially in the asset protection realm, is you say, first, do no harm. In other words, don't lose them at deductions. Like somebody who lives in Texas or Florida that owns their house outright, don't go playing around with that because they have an unlimited homestead exclusion. Nobody can take their house away. So don't goof around with that. If you have a pension, don't goof around with it. It's protected. It's OJ money. You know, OJ Simpson owes $50 million. They can't touch his NFL player's pension. They can't touch his home. There's things that they can't touch. So don't mess around with that. Here, I just look at it and say, look, if you're a stock trader, you have capital gains. Don't mess around with it. I don't want to mess around with your capital gains. I want it to flow down to you. But if I can offset and get expenses back out to you, so let's say this corporation owes you money, and it could be that you're working with your kids. So let's say that you're doing medical, dental, vision this year, and you have co-pays, you have deductibles, you have cell phone, you have car expenses that you did with your business, you had online expenses, you had internet, you had trading, the trading room. So you had, I think I may have just killed my thing. Inadvertent slip of the pen. Let me put my presentation back up. You get all that fun stuff here. There we go. Sorry about that, guys. So you have all those different expenses, and all you're doing is going from the corporation. All we're doing is going from the corporation right back out to you in your brokerage, in your account. What you may end up doing is making it a little round trip. So let's say there's $20,000 profit. That's not the full account. You may end up having to pay some of it up to the corporation and immediately pay it back out to you, and then you're putting it back into the account, because where they're going to want to see the paper trail, so they actually want to see the money leave the account. So that's the hardest part. Is some people go like, oh, do I really have to do that? Yeah. Somebody says, why can't all the expenses come out of the LLC? All right, here's why. So when you have an LLC, even in any partnership, or if it's disregarded, so either or, so I'm just going to put an or here, or it's disregarded, the IRS ignores the LLC and it goes right onto your return. Your expenses come down and they would go on Schedule A. And that's called miscellaneous itemized expenses. And under the Tax Cut and Jobs Act, no more miscellaneous itemized expenses. They did away with them. So you can't write it off. It used to be that you were able to write it off if it exceeded 2% of your adjusted gross income. Some of you guys might remember that. And then somebody says, hey, if I have a PEAS, they had a PEAS exception, like they had this amount of, if you made too much money, you started to lose it. So it kind of stunk. But you can't write it off. So John, we have to get it to another taxpayer where it is not something that is being deducted on your Schedule A. So option number one is we just pay, like let's say you were paying a money manager. Everybody had to deal with that this year. They can't write off the money manager expense. You can't write off your accountant to do your personal tax return. A lot of you guys learned that this last year, because that normally would go on your Schedule A, but it's no more. Miscellaneous itemized expense, unreimbursed business expenses. You can't write that off anymore either. All of those went bye-bye. So you're stuck in this situation where you literally can't deduct any of those expenses unless we can make sure it comes off the top. And the way you have it come off the top is it doesn't go onto your Schedule A. The only way that that can happen and avoid that is by doing something called a guaranteed payment to partner, or by having the profit flow up. So we have the 20% that goes up, that comes off the top, and we have guaranteed payments to partner. That's it. And somebody says, should the LLC Corp setup be in the state where I reside or state of Nevada? It could be either, depending on how much money you put into it. Quite often, there's a huge difference between various jurisdictions. And because you're in the internet, you could choose wherever you want to go. So you could, I would probably push you towards Wyoming right now because they have an identical statute to Nevada, and it's a lot cheaper. It's $50 a year for an entity there, but it keeps your name out of the public record. Nobody could ever take it from you. Even if you got sued for $1 million, they can't take your entity away. So I tend to like it. That's something that we sit down and look at you. And don't worry, guys. I'm going to give you guys all free access to a bunch of materials, and we'll sit down with you and look at your scenario. There's no one size fits all. It's always kind of what's going on. Somebody says, what about a W-2 if I have a W-2 work? This is perfect for people that have another W-2 income, because there's no way you would qualify as a trader. And there's a good chance you have expenses that your employer isn't reimbursing you. And even if you have medical insurance, everybody's getting co-pays and deductibles up the kazoo these last couple of years. Even ours, we have great insurance, and it's still like $2,500 for a family. So the corporation can be used. Somebody says, can we use the corp only without an LLC? Yes, that would be the second criteria I showed you. I said Trader 1, if you remember, Trader 1, Trader 2, and Trader 3. Trader 2 is when you're just using a corp or an LLC taxed as a corp. And if you're making less than $10,000 a year, I can make all that money disappear. I don't really care. And I say $10,000 a year in your trading. We're going to be able to expense that. It's not going to be a problem. So here's a little things that we should always consider, that we should know. And don't worry, guys. I don't expect you to know it all. And I'm looking over at the clock, and I know that I always go over. I'm going to make sure I stop on time. But these are all the concepts that you really should know when you're trading: capital gains versus ordinary income, short-term versus long-term, investor versus trader. What is a 1256 contract? How it works with Forex? How can it work? Yes, it can, by the way. There's 988 and there's 1256. How crypto is taxed it's not considered currency. It's considered a capital asset. And then mark to market. All of these things you just kind of have to know. I'm going to give you a white paper tonight that you can look at. And I'm also going to give you tickets to come to a tax and asset protection course. I'm going to do one specifically on trading in the future. But all of them, we address a bunch of these topics, and we break down how different things are taxed and how you can protect it. How ordinary losses work. By the way, we can carry those back 5 years, and we can carry them forward forever. Capital losses offset capital gains. Otherwise, you can take $3,000 a year against ordinary losses. And then passive losses, you can't use it all except against passive gains. And there's two exceptions: when you're a real estate professional or whether you're actively involved in your real estate. Otherwise, you cannot use passive losses. There's one other exception, which is tricky, which is when you dispose of an asset that has generated the capital loss, it releases those capital losses, and then they become ordinary. So accountants love this stuff. This is like crack for accountants. They just love the idea of like, wow, you're completely hosed except in this one position. How can we get you in that one position? And that's what they do. So in trading, that's why we look at it. You're like, man, you're just completely hosed all the time unless you structure it this way. Let's structure it this way. And then you're like, wow, this really works. And in 20 years, it's saving you a ton of money. And I know enough to know that $1,000 over 40 years at 7% growth is going to be almost $500,000. That little bit of savings really starts to compound over time. And you guys are all traders, so you can get that. Last thing's holding options. You could do it as an individual in your living trust. Sometimes what we do, because the brokerage companies, and some of you guys may have dealt with this. If you try to open up an LLC in the brokerage company, they try to hit you with professional fees. The easiest thing to do is to put it in a trust and assign the beneficial interest to the LLC. It's kind of a workaround. It's kind of, they don't need to know. You could have it in a trust, like in a retirement plan. Quite often, if you have a 401k, you're setting up a trust or a personal property trust, or it's in some cases, it's literally an irrevocable trust for somebody that maybe has special needs, or it's, somebody's passed away and it becomes irrevocable. You have retirement plans, which is your IRAs and your 401ks. And then you have your businesses like LLCs, LPs, and corps. And they all are treated a little bit differently. I'll give you these slides so you can look at them later, but whatever you're looking at it, you're saying, hey, where does it go? So it's just like I told you, like your income we want it to flow onto your schedule B and D. That's the best place for your income, but we can't write off the expenses when you're a trader. So we're going to end up using other. What we want to do is make sure your income is on you. So let's just say this is your 1040, and the expenses we want to get over to a corporation. We want it on a corporate return. It's not on this chart because we're going to remove it from our personal realm. It's not even going to show up here. So if somebody says, did you take expenses? The answer is no. I just reported all the income that I was required to. And it comes down to you via something called a Form K-1. So if the K-1 says I made 20 grand, I have to pay tax on 20 grand. If the K-1 says I made 2 grand, you pay tax on 2 grand. It could be that you made the same amount of money, you just managed to expense a bunch of it through the corp. So big mistakes traders make, we always see, they don't understand how their activity is being taxed. I would really urge you, it ends up being, and I've tried to do studies on this, you save about $1,000 per hour that you work on taxation. So if you spend a little bit of energy on taxes, it's worth your while. The big one that I always see is losing your deductions. I always think of REM and losing your religion, right? It's losing your deductions, and you don't get to write things off, and you usually don't realize it until it's like usually it's 6 months after you had the expense, or a year and 6 months. Like the tax year ends, and then somebody's preparing your return, and they're like, we can't write anything stuff off, and then you're halfway through the year, so you freak out for the remaining 6 months, and then another year hits you, and then you're even madder because now you're not going to get the deduction, and by now it really matters, and you're like, oh man, this really sucks. And then you also have the wrong entity structure. Some people really get themselves burned. Don't think of entities as being these really horrifically hard to operate. There's really 3 categories that entities fall into. You have the state, what the state says, and it's going to be either a corporation, LLC, limited partnership, limited liability, like there's all these different names, DBAs, trust, all these things exist in a state. And that just means every state is a little bit different. So different states have different rules, but third parties always look at the same thing. So if it's a bank, if it's a brokerage house, if it's a judge, if it's an auditor, they're always going to look at things and they want to see that operating agreement. If it's an LLC, it's an operating agreement. If it's a corp, it's the bylaws. Partnerships have partnership agreements, but it basically says, here's the rules. And you could inadvertently just screw yourself up because you use a set of operating, like the operating agreement from LegalZooms. Those are horrible. And they have all these different problems in it. You'll never be able to get an account open. You'll be like, you'll never know why. It's because they're rejecting you because it's built for a whole bunch of different owners. It's almost like it's a private placement. If you go over here though, and then you say, hey, now I'm dealing with the feds, they don't care about either of these. They don't care about your documents. They don't care about anything. All they say is, tell us how you're being treated tax-wise. So if I set up an LLC, I could be taxed as an individual. I could be taxed as a partnership. I could be taxed as a corporation, either an S or a C. I wouldn't be a nonprofit in that one. I could even be taxed as a trust. And the IRS says, oh, that's what you are. So if I set up an LLC and tell them it's a C Corp, guess what? The IRS says that's a C Corp. If I set up an LLC and tax it as a partnership, guess what? They say it's a partnership. Somebody says, what if we need to show a particular income to qualify for a mortgage? This is the perfect this is where you can actually control your expenses. So if I want to show higher income, I could tell you that when you have a C Corp, all you'd have to do really is say, hey, I'm going to give it a little bit of extra money and pay yourself a little bit of extra W-2 to make sure that you achieve your loan. Now, it's still taxable income to you, but it's deductible against your income. So if I wanted to do that, I could take something where I'm making money over a year and I could pay it out to myself over a 3-month stretch and show really great W-2 income in addition to my work. And because it's a C Corp, they don't go digging into the C Corp. S Corp's a little bit different. The other thing that's interesting, because I spend a lot of time in real estate, is that the Freddie and Fannie guidelines right now say that they use 70% of income off of the front page of your Schedule E. So page 1 is 70% of that income they use. On page 2, which is where your income shows here, it shows up as 100%. So you can actually get a little more bang for your buck depending on what you're investing in. And if that went over some of your guys' heads, I apologize, but this is the stuff that we do day in and day out. So I'm just stream of consciousness for me. Can you use the corp? Yes, I started trading this year. Can I get these entities set up for the year and cover my expenses? So Susan, the answer is yes, kind of. You can't offset the income you've already made. So it looks like this. So let's say that today, let's say this is 12/31 and this is 2020 and this is 2021. And let's say that you spend money all throughout the year, expenses, and then you incorporate here, and then you spend money. These expenses you can write off, but it's called a startup expense. If it's $5,000 or less, you can expense 100% of it on day one. If it's more than that, then we have to be then it's going to be stretched out, and they call it amortizing. It's kind of like depreciating ability. You amortize it over time. Somebody says, how about rental incomes and real estate? Should they be treated? We can actually do the same setup, and it works great. What we love to see is when you have a structure, I'll show you a typical structure for our client. We'll have a corporation, and it could be an LLC, taxed as a corp. We call this the family management. Family manager. Then you have a holding entity, the LLC, for your real estate. We'll just say this is real estate, and this is your investments. We call this cash because there's no liability when you're trading. And everything flows up. So if I have real estate, you're probably aware, usually you're setting up different LLCs in different states. So we'll just call these little LLCs, right? I could have them all pointed to this. So I have one tax return here, 1065, one partnership, one tax return there. And then I can be paying my kids. I can be paying my spouse. If I like my brother, I could be paying my brother. If I have family, I can have them on my board. And I can say, hey guys, we'll cover your medical, dental, vision, or whatever. So you can, hey, we're going to grow this thing as a family. And then if something happens to you, by the way, you don't own anything other than the interest in the LLC. We generally place those in trust, so living trust. So we don't have to probate the heck out of it. It ends up working really well. Now, I know that I've gone over. I thought I was going to hit it. I threw a little extra session in there, the Trump versus Biden tax plans, but I don't think we're going to have time to do it. That was my safe gap. So what I'm going to do is give you guys a gift. The gift is really simple. I'm going to give you a white paper. I'm going to give you a free book, and I'm going to give you tickets to a workshop, either a 1-day virtual workshop or when we start doing them live again, a 3-day, absolutely free. There's no strings attached on any of this stuff. Just go to ABA Link Traders, and all we care about is people learning how to, take your time. It's all right. So we're good. All right. And we'll just go through here. I'm going to give you guys a couple other things. Here's some fun stuff. I'm going to give you my book, tax-wise, right there, and the white paper that breaks all this out into writing so you can actually, some of you guys, I always know the doctors. The doctors read everything. Some people just like to watch videos, and then the doctors won't watch a video. They always go and they're sitting there goofing off, and they're reading everything. And I'm like, you guys don't have time to read everything, but they read everything. We'll give you the tickets. We'll give you everything. All you got to do is fill out a little bit of information. We're not asking for credit cards or anything like that. By the way, tax-wise, this is the 4th edition. Done this before, been to this rodeo quite a few times. It's pretty simple, easy read. It'll show you a whole bunch of deductions you didn't even realize that were sitting out there. The Trader Special Report's going to break this down into bite-sized pieces. The Tax and Asset Protection Workshop is awesome. We love it. We love working with real estate investors. We love working with stock market investors. We love working with small businesses. And then last little bonus is that if you want to have a strategy session, we don't twist arms. We just say, hey, if you want us to map out what your structure would look like. So again, like let's just say that it's somebody who's got a little bit of real estate over here. So we'd have an LLC. Let's say they had 3 pieces of real estate, a couple, maybe an apartment building. We'd have that go to your 10 to you, or let's just say, actually, we'll have a corporation managing it. We'll have your stock account here as an LLC, and everything flows down. All of these guys all flow down to you, and we just have a living trust or something catching it. And that's what a structure, that's what a blueprint would look like. So I have all these assets over here. Here's how the money gets separated. And it works great. And here's my, we do an estimation of what the tax savings would be. Quite often, if you become a client, I can tell you what we do. We go and we look at your past tax returns, and we immediately start digging into whether there's money that you left on the table that we can find. Because there's nothing that endears you more to your tax lawyer than you paid them $100 and they saved you 10,000, right? So we love those types of returns where you say, oh my goodness, you just save me 10 times what it's ever going to cost me to work with you guys. That ends up being great. And if you think that's too high of an estimation, then you haven't worked with tax attorneys before. That's what we're good at, is trying to make sure that you get the money and keep it in your pocket. So anyway, so that's it. That's I think it's enough to give you guys and wet your whistle. Raghi, if you're flowing around out there, you tell me. I answered a few questions, but I think that most people want the Trump and Biden. I just don't have time. It's going to take half an hour to wrangle through that stuff. I can just tell you that as a trader, the best possible scenario statistically is Biden being the president and having a split Senate and House. The average is about 16.6%. Now, some of you guys I know are like, hey, I want Trump. Well, Trump, it still wouldn't be bad. When you have an incumbent president stay in, your average is about 7% the year after, especially when you have a split Congress. So either way, we win, as long as we have a split Congress. I don't think Biden's going to be able to force anything on us, but you get. I don't have a crystal ball. I don't know what's going to happen with all these lawsuits. We don't know. All I know is that we have a presumptive president-elect of Biden, and we'll know more when we actually have a president-elect in the future. All right. So, yep. Somebody says free TaxWise book, all that fun stuff. Cool. We'll make sure that we get it all for you guys. So please take advantage of it. There's a bunch of material, a lot of reading material. And then when you're ready, we're happy to work with you and see how much money we can keep in your pocket. Raghi, you tell me, is there anything else you want?
Man, you are the best. That was amazing. I don't know how many times I've sat through this with you, but every year there's something new. Every year there's a new twist in the plot. And, this is where I'm glad I don't have to worry about any of this. This is why I have you guys. So thank you as always. Gang, exactly. I've been seeing great information. Cool. This is the kind of thing, gang, that a lot of us, we're studying our indicators, we're studying our courses. That's great. But this is very much a foundational thing for me. Like I said, all my family, we go through Anderson. So, I don't know what else to say other than these are the people that I trust, and Toby is the best. And now you guys know that. So, man, I could gush, but you're the best, man. Thank you so much. I like you a little bit.
It's better than lawyers suck and they're all evil. All right, I'll get out of your hair. You guys are awesome. I don't know if you have anything else to go through, but you guys were fun. Great questions, by the way. I could tell there were some people that weren't sleeping through it, so that's always good. I don't know. I'm always wondering. It went so fast, though. I thought it just felt like we just started.
Because you're amazing.
It's crazy.
And this is information. Yeah, absolutely. Bo, he's the best. Guys, so you guys have everyone, you have the link, ABA, Anderson Business Advisors, aba.link/traders. I've got 2 copies of TaxWise on my shelf. I've got courses Gosh, Toby, I've got courses from trading as a business. Oh yeah, I keep all that stuff. So I'm actually
Still
looking forward to
works.
checking out that blueprint and white paper.
You know what's weird? Still works. Everything we were teaching back in 98, 99 still works. Everything else has changed. Like they messed around with the miscellaneous itemized deductions. They messed with trader status so much. Stuff we've been teaching is just kind of like plain Jane, no frills, and it works just as good as all the strategies back then still work too. So
Well, you
anyway,
guys were
thanks,
thinking
Rocky.
outside the box. Yeah, you guys were
Yeah, I
doing things
appreciate it.
nobody else was doing, even when I met you back in '05, and you guys continue to be the leaders. So, but thank you so
You
much,
rock.
Toby. Thanks, gang.
All right.
Again, check out
Thanks, guys.
aba.link/traders. Educate yourself, and when you do, it just makes so much more sense as to why this is something you've got to understand as far as your trading and investing life. And Toby covers so much more. So, thanks again, Toby.
All right. Thanks, guys. Thanks, Rocky.